Before we can proceed to the call, let me remind you that the discussions may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause future result, performance, or achievement to differ significantly from what is expressed or implied by such forward-looking statements. Please note that we have mailed the result and presentation, and the same are also available on BSE and NSE website. In case you have not received them, you can write to us. We'll be happy to send it over. To take us through the result and answer all your questions today, we have the top management of Anupam Rasayan India Limited, represented by Mr. Anand Desai, Managing Director, Mr. Amit Khurana, CFO, Mr. Vishal Thakkar, Deputy CFO and Head of HR, IR. Dr. Kiran Patel also had to join the call, but unfortunately, due to some personal exigency, he could not be here. We will start the call with a brief overview of the quarter gone past and then conduct Q&A session. With that said, I would like to hand over the call to Mr. Anand Desai. Over to you, sir.
Thank you, Kanav, and welcome everyone to the Q4 Financial Year 22 earnings call. I hope you all are doing well. This year gone past has been a good one, wherein we achieved a lot of our strategic goals, resting on the three solid pillars of innovation, financial prudence, and environmental sustainability. Our consistent growth and profitability has resulted from our strong focus on the execution of our current strategies while keeping our eye on the future. On a full year basis, we have witnessed a total revenue growth of 29% versus financial year 21. We have seen our PAT more than double this year vis-a-vis financial year 21, which has culminated into a PAT margin expansion of almost 600 basis points. We continue to deliver value to our stakeholders by the means of increased top line and bottom line, which is driven by volume ramp up and which was a result of enhanced trust of our existing customers and continued financial and operational prudence. We specialize in the synthesis and manufacture of life science-related and other specialty chemicals that need multi-step synthesis and sophisticated technologies for a broad base of Indian and global clients. Our expansion of fluorination chemistries will drive our next phase of growth, and which has been strengthened by our successful acquisition of Chemflex 26% stake from Aditya Group and public open offer on a combined basis. And by the means of this acquisition, we look forward to backward integrate our supply chain in this vertical and further focus on producing high value, high margin molecules that have application in varied industries, which will enhance our margin profile. Initially, we will be focusing on three key fluorination segments, specialty fluoropolymers, the potential top line addition from this will be around 100 to 200 million per annum in the medium to long term. We will continue to invest in R&D to enhance our product profile and margins. I want to state that in this last March, we have commissioned the extension of our existing R&D center, which can house more than 100 professionals. Currently, we have a strong team of 77 scientists, of which there were 66 in the last quarter, and that is quarter ending 31st December 2021, and this number will further expand going forward. This innovation-driven philosophy has further added value to our customers' expectations, and which will ensure growth in the long term to be with a sustainable business relationship. Further, Anupam continues to be their preferred partner. Further, in this volatile environment, we have been able to provide consistent and timely supplies to our customers, which is largely due to our inventory holding strategy. Most of our products are strategic and an integral part of the customer's supply chain. Also, as all the products are supplied under contractual agreements with pass-through price mechanism, which ensures clear visibility of consistent offtake with sustainable margin. I want to conclude that the past 2 years of all-round investment in different capabilities has powered our growth and shall further enhance our financial metrics, of which all our stakeholders, that is customers, shareholders, employees, and society as a whole, are going to reap benefits of. Now I would like to hand over to Amit Bhai, our CFO. Amit?
Thank you, Anand Bhai. As Anand Bhai talked about FY22, now I want to draw your attention towards some of our growth metrics in perspective of last 5 years. Our number of customers have grown from 53 in FY18 to 68 in FY22, out of which 5 were domestic and 10 were MNCs. Our product offerings have grown from 25 in FY18 to 48 in FY22, growth of 92%, out of which 17 were related to life sciences and 6 related to other specialty products. Our installed capacities have grown from about 12,000 metric ton in FY18 to 27,000 metric ton in FY22, a growth of more than 100%. Our R&D people strength has grown from 19 in FY18 to 77 in FY22. Now talking about our financial growth in these 5 years. Our revenue has grown by 212% from rupees 3,414 million in FY18 to 10,660 million in FY22, recording a CAGR of 26%. Our gross and EBITDA margins have grown from 54% and 23% respectively in FY18 to 65% and 29% respectively. Our ROCE has grown from 9% in FY18 to 12% in FY22. Our front-ended capex of more than 800 crores has resulted in significant growth by leading to 10 to 12% return on capital employed ratio during the expansion phase. As Anand Bhai mentioned about our 10-fact deal, and as you all know, we have successfully acquired 25% stake from Aditya Birla Group for rupees 148 crores, and apart from that, we have additionally acquired 1% from public via open offer, which closed on 6th May 2022. We are in the process of integration with 10-fact, for which we have onboarded a top global consultancy firm for smooth integration. Till now, we have already integrated key functional areas like IT and HR. We have been continuously informing in past few calls about our focus on sustainability of business and environment alike. I am happy to announce that we are investing 27 crores for 7.5 megawatt solar power plant, in addition to 12.5 megawatt we had commissioned in earlier part of the year. Through these investments, we have ensured a saving of rupees 3 crores in the year gone by, which is expected to increase to around 11.5 crores in FY23. Now I would like to request Vishal Bhai to walk us through our financial performance for the quarter and year ending March 2022.
Thank you, Amit Bhai. Hello everyone, and thank you for joining us here today. I would like to briefly touch upon the key performance highlights for the quarter and year ended March 31st, 2022. And then we will open the floor for questions and answers. Before I proceed, I would urge all of you to go through the detailed presentation submitted to the exchanges and uploaded on our website. The financial highlights for the quarter ended March 31st, 2022 are as follows. Total revenues were 3,169 million rupees in Q4 FY22 as compared to 2,743 million rupees in Q4 FY21, registering a growth of 16% on YOY basis. EBITDA including other revenues was at 969 million in Q4 FY22 as compared to 655 million in Q4 FY21, growth of 48% YOY. This would translate into EBITDA margins of 31% for this quarter. Profit after tax was at 461 million rupees in Q4 FY22 as compared to 221 million in quarter 4 FY21, the growth of 108% YOY. Now we move on to the financial highlights for the year ended March 31st, 2022. Total revenues were at 10,811 million in FY22 as compared to 8,373 million in the same period last year, growth of 29% YOY. EBITDA in FY22 was at 3,112 million as compared to 2,202 million in the same period last year, a growth of 42% YOY. In percentage terms, we have our EBITDA margins at 29% in FY22 against 26% last year. Profit after tax was at 1,522 million as compared to 703 million in FY21, registering a growth of 116% YOY. In percentage terms, we have our PAT margins at 14% in FY22 as against 8 percentage points in same period last year. Now moving on to the segment-wise performance for FY22. Our life science segment contributed 9,543 million rupees compared to 7,429 million in FY21. While other specialty chemical segment contributed around 1,086 million rupees compared to 680 million rupees last year. In percentage terms, life sciences segment contributed 90% of the total revenue and balance 10% came from our specialty chemicals. As far as revenue breakup is concerned in terms of geography, in FY22, the contribution of India was 44%, Europe 26%, Japan 12%, Singapore 11%, China 4%, North America 1%, and 1% came from the rest of the world. Our top 10 customers contributed to 80% of the total revenue, and there are total 24 products that we provide to them. With that being said, let us open the floor for Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kumar Saumya from Ambit Capital. Please go ahead.
Hi, sir. Good afternoon. Sir, my question is on the balance sheet side. If you could highlight what is our strategy going forward, because our inventory has further gone up by 90 days. And how do we look forward to going forward, like 1 or 2 years down the line? How do you see it panning out?
Okay. So yes, we recognize that our inventories have gone up, and we would appreciate that the current environment required us to be at this level. Due to the volatility that we have seen in the market and in terms of supply chain disruptions, this inventory has been at this level. As we go forward, once the environment stabilizes and the supply chain comes back to normalcy, we would expect this number to go down significantly, maybe next few quarters going forward. I hope I've answered your question.
Yes, sir. So in the last quarter, we had highlighted that we are undergoing some contract negotiation with our customers, out of which 50% has been done and 50% will be done by the next year. So how are we progressing on that front?
So that has been progressing well. So customers have appreciated our request for changing the contract terms, terms in terms of making the pricing at 6 months rather than yearly. However, this fluid environment and volatile environment, customers have. That's the reason that the unwinding of these positions and what you see would take a little 1 or 2 quarters beyond what we would have anticipated as we go.
Actually, on the debt side, sir, because the inventory is consuming so much capital currently, and we are using the debt to fund it again. So how do we see the debt going forward from here? Like, we have seen a significant rise in debt year on year.
You're correct here as well. However, what I can answer here is that as we go, our inventory days would drop and our cash profitability would continue. So there will be release of capital from the operations, which would ensure our further growth. And we do not expect any significant movement in terms of any debt requirement for our working capital growth.
So what is our current year capex guidance?
Okay. So our current year capex, we are expecting the capex as we had guided in the last quarter as well, that it would be 250 crores. This will be primarily for the LOIs and contracts that we have signed, And this we anticipate that we would be able to generate an asset turn of 1.75 times and an ROCE of 20% on this capex.
Okay, sir. Thank you. That will be all.
Thank you. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Thanks for the opportunity. So, continuing with the earlier one, so 250 crore capex, and you mentioned 1.75 asset turn. My presumption is large part of the revenue visibility here will be contractual in nature. Over what time frame should one expect the peak revenue to be visible in the numbers?
So again, I would put it that the peak revenue we would expect in FY25-26 primarily. Because 1 year we will take in the capital asset creation, and then 2 years to ramp up fully.
Okay, so it will start taking in, let's say, FY24 onwards, and 26 will be the peak year in terms of utilization, right?
Yes. And Ankur, just to inform, there will be commercialization of these few molecules may happen a little early or would happen a little early, because we will have small quantities which will start flowing from our current existing capacity as well. However, as you rightly identified, the bulk and the significant revenue would come from the later half.
Okay. That's helpful. Secondly, just continuing on the working capital side as well. While I take your point in terms of higher inventory given the supply chain shock globally, and this inventory, my presumption is, will be at a relatively higher cost given the macro that we are in. So inventory that you could share in terms of the pass-through of this elevated prices and the customer understanding there.
So Ankur, good that you have raised it, and I would also want to clarify here that as you know, that our contracts are passed through, and all the costs that we incur is passed on to my customer. This inventory that we have stocked up is also in consonance with our customers, and they are aware of the inventory that we are carrying in terms of volume and also price, and they are comfortable with this, because if you see in this whole business, and you know it better as we speak going, that our business is about supply, being part of the supply chain, and today the customer is very keen on ensuring that the supply chain is not disrupted, and that we are one of the part of this supply chain, right? And hence they are more concerned and focused on that would we be able to deliver on time and in terms of volume that we have discussed and agreed upon. So customer is fully aware, customer is fairly comfortable with these numbers and cost and volume as well, both.
Okay, fair enough. And will it be right to understand that since the last quarter we were saying that almost 50% of the customers have agreed for a 6 months pricing versus 12 months. Any update on that number henceforth, or we are still at around 50% there?
So right now we are around 50%. The discussion with the other customers is progressing, but in the current backdrop of the environment that we are in, it was prudent to be more focusing on right now delivery and supply chain logistics rather than get into this for now. Our customers have also requested us that we appreciate and we would want to do that. However, just let's wait for this volatility to just taper down a bit, and then we start rolling out those changes. But we are reasonably comfortable that we would be able to get it over next few quarters.
Sorry, just a clarification. If I got you right, while the customers have agreed for a 6 months pricing, it will take probably some time for it to be effective in terms of numbers. And the elevated inventory is because of the RM volatility there. Is that right understanding?
Yeah, so volatility is because of the inventory is because of this volatility, yes. And yes, whatever are the pricing mechanism and all, but we would have to unwind it as we go, right? We would have an inventory which will unwind over a period of next 2 to 3 quarters or 4 quarters, and we will get to a stabilized numbers as we go. So you will start seeing changes in a quarter or 2, but you will see a chunk by the second half of this year.
And whenever we see that change, let's say 6 months out, will it be a sharper one, or we'll be back to those 200 days only, given that, we had earlier guided for around 150, 160 days on the inventory front earlier?
Ankur, I don't want to peg a number as of now.
I don't want to peg it to a number, but directionally, will it be more closer to 200 or even lesser than that?
Right now, let's look at a number which is what you are speaking, and then we will strive to the next level. So let's take one step for the first, and then the second step for the other one. Let's take it that way, I would say. And once we get more visibility, see, today the problem is that whatever I say, where the world moves, none of us really know well, and hence I don't want to guide or even allude or indicate to anything which tomorrow we will have a conversation on that again. So just wait for a quarter or two, let the things settle down, and then we can have a more longer term visibility on these numbers.
Sure. And just one last question.
I was going to add one point. This is Anil here. Just want to add one point on what Vishal has mentioned. See, we, as all these products under contract, and all the contracts have a pass-through mechanism. So every customer knows what prices we have agreed when in the past year when we agreed on the price. In the meantime, there's a tolerance level for each price or each raw material price. And once that raw material tolerance is breached, we immediately inform the customer that this raw material price has breached now from the agreed sum, and we would like to bring to your notice. The moment we do this, and which is a mechanism built into the contract. So the moment we do this, the customer is aware as to what we are doing, and he understands it. And he feels his confidence, as mentioned by Vishal earlier, that, okay, fine, go ahead. And on the contrary, when Ukraine war started, in February itself, all the customers started telling us that Eastern Europe has got a huge amount of refining capacity. So please start building up your stocks on your crude derivatives. So based on those information also, because most of the customers and our larger exports are to Europe, so they gave us this guidance that please collect material now because there will be a shortage or there will be a price increase. So I'll just use, for example, propylene oxide, which is a basic product. Today it is 240 rupees and very short profit. We have to stock. Similarly, in other derivatives, Phenol has gone to route, we know about that. So that is what the customers guided us, and we have done based on that. And again, these issues have happened in the past, which has of holding.
Yeah? Sorry to interrupt. Your voice is breaking up, sir, in between.
Can you hear me now?
Yes, sir.
Okay. So we have gone through this in the past. We have faced these issues even in learning times. Then in China, the air pollution war, n number of times in different levels. So this policy has been ensured by the customer and by us together, and which also ensure that we keep track of our margin, and it has helped us a lot. I know from your perspective that the inventory is increasing, but as mentioned by Vishal, let 2 quarters or 1 quarter go down, and I'm sure we will be able to pass through this high-quality, high-priced inventory back to the customers as per the contractual agreement, and we will be back to normal in the past. And going forward, we would like to bring to the days of the inventory as what mentioned by you.
Sure, Anand. That's helpful. Just one last question, if I may. What is the typical, let's say, average RM inflation that we are seeing? I know it will vary from product to product, but broad range will be helpful.
So again, on the crude side, I would say between 100% also, in some cases to around 40%. On the soda ash, you know what has happened. You would know on the caustic soda also what has happened over there. So I think 30 to 40% is what we anticipate. But I think prices are getting cooled now. I give 1 more quarter, things should go down. The only problem is that India people who are using natural gas, they will be using natural gas for 6 months next, which is sent to the government from April to October and October to April every year. So that is something which we have to take confidence of. Otherwise, I think there should be a cooling down going ahead because demand will be reduced at this price.
Sure, sir. That's helpful. Thank you and all the best.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may be requested to rejoin the queue. The next question is from the line of Vidit Shah from IIFL. Please go ahead.
Hi, thank you for taking my question. My first thing was some clarification on this 220 to 260 million growth revenue accretion top line possibility that you've spoken about. So is this like the total revenue that all the LOI contracts can generate, or is it what you expect annually out of these contracts?
What it will be is 2,600 crores that we have talked about. This is the total value of the contract over 5 years. Contract and LOI over 5 years. So at the peak, when all the contracts and the LOIs are in play and at their optimal values, we should have around 500 odd crores of revenue from these ones. So basically, whatever is 2,600 crores divided by 5 is the number that you should look at.
Okay, got it. And secondly, this debt that is being added in FY22, that you mentioned earlier was largely to fund the working capital, and that is expected to unwind over the rest of the year. So what is the ideal debt position that the company is looking at? Is it back to FY21 levels, or even lower than that?
So and one is.
So sorry to interrupt. Your voice is breaking up.
Am I now better on this?
Yes, sir. Please proceed.
Okay. So the debt you should divide it into 2 parts or 3 parts primarily. One is the working capital debt. 2 is the debt which I have taken for the acquisition of Tanfac shares. And the third is my shareholder debt, which is my from the KPI LLC. So if you look at whatever debt, my working capital debt will be around about 220 crores, or 200 crores at the year end. And that, even with the increase in the growth, this number should stabilize as my my working capital days reduces, because that will take care of the elevated level of business.
Okay.
Right?
And the rest of the 2 debts are paid over how much time?
Yeah. So the average tenor is around 5 years. So you should unwind it over 5 years now. And promoter debt is in next 3 years we will pay it off, because it was a historical debt. So you should unwind it over 3 years, and the balance debts you should unwind it over 5 years.
Understood. And just one last question was regarding any revenue guidance and margin guidance that you could give for FY23, and how is Tanfac accounted? Is it being accounted as a subsidiary, and thus revenues being added there, or is it just associate? Is it an associate where we add the profit of 70 lakhs right at you?
Okay. So first point I would want to answer about the guidance. I would prefer to just suggest that historically we have grown. If you look at what even Amit Bhai said, that in last 5 years our revenue have grown by 26% odd, and we expect that over next time period also we should continue the growth journey there. In terms of margin, we have been historically at the margin levels, and we expect that historical margins of last 2-3 years on an average should continue.
Okay, got it. And just lastly on Tanfac.
So on Tanfac today, we have taken it as an associate only. But as we go forward, we will have a conversation with the auditor, and we may be able to do it on a line by line consultation. However, we'll come back to you in the next call on that.
All right. Thank you so much.
Thank you. The next question is from the line of Madhav Marda from FIL. Please go ahead.
Yeah, hi, good evening. I think some of my questions were answered, but just wanted to understand what is our average cost of debt across the working capital, Tanfac, and the one from KPI LLC. Could you just help us understand the blended cost of debt?
Okay, sure, Madhav. So Madhav, if you look at my KPI LLC, debt is at 3% on a USD number. My working capital debt is primarily PCSC based, PCSC discounting numbers, so which will be L plus 0.75 to L 1.5. So on an average, you can take it at L plus 1.2 odd average should be the number there. And my term debt, if you were to look at it, will be hovering around 7.5 kind of a number here, 7.5 to 8% number, because it's also acquisition debt included in it.
And the KPI LLC, the 3% US dollar debt, that we would have a natural hedge from some of the exports that we do, right? So we don't need any.
Exactly. Yes, you're right. So we have a natural hedge. In fact, if you look at it, we are surplus on dollar income. So we tend to hedge dollars on an income side rather than on an expense side.
Okay, got it. And in terms of the top line guidance, I think you already mentioned it, but basically last 5-year average you said is 26%. So next couple of years we're expecting to grow at that 25 to 30% CAGR, right? I guess that's what you're saying.
I would agree to that.
Okay, got it. And I think already this question has been asked earlier, but on the inventory days, like, do we expect it to normalize by September, or by next March we expect this number to come down to 200 days again? Like, any sort of thought process that we can have?
So Madhav, I think just one thing I wanted to just put a big caveat here, that how the world evolves. Because if tomorrow China, Taiwan happens, then I don't know where we will be and what our customers will drive us to in terms of our business requirements. But ceteris paribus, and assuming that things volatility reduces in next 1 or 2 quarters, then in the second half you should you should start seeing the improvements. That I would say.
Okay. Got it. And any update on sort of the telecom related molecule that you all had spoken about? There was a new molecule there, and is there any other potential M&A that you all are looking for like technology or market access, anything like that?
Vishal, can I take this?
Yes, sir. Please, Anand, please.
Yeah. So Madhav, thank you for asking this question. The 2 products which you mentioned earlier, the validation is still going on. We anticipate the validation to still continue for another 9 months, that is till next March or maybe February. That is the plan given to us by the customer. So every month we are sending them few kilos of material which is being validated every month. Because as you know that the semiconductor which is going to be made out of this product has to have a very good stability at high temperature. So that is, those tests are going on. We are continuing to do the pilot runs only on these 2 products. At the same time, we have added 1 more product in similar chemistry from a different customer, which is again going to be used into an electrical application. Again, all these 3 products are non-fluorinated products. Going forward, we are working with a new customer in the US, with whom we are working on around 4 products, which are again electronic chemicals. Electronic usage chemicals, but not in semiconductors. So this is the idea. Those 4 new products, we will again inform you in the next update. But as of now, we are happy to inform that the two products are validation is going on. Customers are happy. 1 new product has been added. All of these 3 are going to be used to manufacture semiconductors which are used for 5G application. And we have got 4 new inquiries also which are fluorinated for applications in electronic chemical usage.
Good. And on the M&A side, is there anything that's such a?
We are looking at it. We are looking at it very seriously. Evaluating the right mix. We have been serious about it, but as of now, we don't want to comment on it.
Good. Okay, sir. Thank you so much.
Thank you. The next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Thank you and good evening. Can you hear me?
Yes, sir. Please proceed.
Yeah. So congratulations on your good results, Anand bhai, Amit and Dishant. So my thoughts are, one is when you talk about the asset turn and the ROC for the capex you're talking about for the LOIs and contracts, it seems to me that you're building in lower margins because you have 1.75 asset turns you're getting an ROC of 20%. That means you're assuming an EBIT margin of just about 11%. So are these lower margin contracts? How does it work?
Anand bhai, can I take this call? Can I take this question? Should I take that?
Yeah, please do.
Okay. So, Mr. Ramesh, the asset turn is 1.75, and here ROC, when we calculate, we also included the working capital that will be required additionally on this turnover, and hence this is 20. Our EBITDA margins will be in the north of will be similar to what we have been historically achieving.
Okay. And second thing is in your order details, you mentioned 1,800 crores is still LOI. So when do you expect those LOIs to get converted to firm orders?
Anand, would you want to take or?
No, you go ahead. You go.
Okay. So see, these LOIs are under negotiation discussions, and probably another 6 to 12 months time, we should be able to conclude it. But nonetheless, what happens here is that the development process and the validation process and others are continuing, and in few we are doing the pilot activities as of now, and we are reasonably comfortable with this timelines that we have been seeing. We have been believing that we should be able to get this monetization of these contracts and LOIs.
So this 250 crore capex is for the entire 2,600 crores of combined value of LOI and contract. You don't need any additional capex once these LOIs are converted.
Yes, you are right here.
Okay. Yeah, so finally on this fluorination chemistry, you have given some target addressable market. So what is the broad timeline you are looking at in terms of showing visible progress, and what are the kind of additional investments you'll have to make? What are your thoughts on that?
So see, this is the potential, and as we had also mentioned, that this is the timeline we're looking at a medium to long term. So right now, these are opportunities where we are working on the molecules, working with the customers, and building it in our lab as of now. As we form up and as we finalize these molecules, we will then size the capex and size the contract capacities and the capex plan from then on. So today, I would not be able to offer any guidance on the capex side. However, these are all very high margin products. So it should be more value accretive than what we have today.
And similarly, on the capex required for TANPAC, both in terms of processing potassium chloride and downstream HF derivatives, what is the progress you have made in terms of business plan for TANPAC and the derivatives?
So in this the TANPAC side, we have been working with the TANPAC management as well, and we have at least identified few capex programs and the capacity expansion, which will be in the tune of around 50 odd crores, which would be undertaken in next year, and that should significantly ramp up the capacity.
So 50 crores will be capex within TANPAC?
Yes.
Okay. Thank you very much. I'll join the queue. Wish you all the best.
Okay. Thank you.
Thank you. The next question is from the line of Chetan Thakkar from ASK Investment Managers. Please go ahead.
Good evening, sir.
Good evening, Chetan.
Yeah.
Yes, you are audible. Please.
Okay. So the question is on the LOIs. So while the LOIs are for 5 years, is it fair to assume that they'll even continue after that and there'll be renewal of these contracts, or is it just a 5-year term? So just wanted to get a sense. I understand it's a first 5-year contract, but do you see that recurring again going forward, or it falls off the cliff after 5 years?
So Chetan, if you see our history and if you see how our product revenues have gone up on each of our products and over the period, it will be a reasonable assumption from our side to expect this to continue further, because these are the products which my customer is using is going to use for a longer period of time, and hence we believe that it would continue here.
Understood. And sir, our earlier estimate of hitting 1600 crore of revenue on existing capacity, that is irrespective of these LOIs. Is that assumption correct? And this builds on to that 1600 crore.
Sorry, I couldn't hear you. Can you repeat again, please?
The 1600 crore potential which was there from our existing capacities, these LOIs are over and above that, or they will help us reach that 1600 crore?
So you have to look at it together, because what will happen, there will be overlap of both the processes. One is my current capacity ramp up will continue, and on the other side, my LOI capex will also come into play. Yes, the numbers that we are expecting in terms of revenue and growth, we would be able to suffice from these capex that we have identified till now.
Got it. And so just one bookkeeping question. On your cash flow, I see an increase in receivables, but that similar increase is not there in the balance sheet. So just wanted to understand, why are those two numbers different? So we see somewhere around 250 odd crore of increase in receivables on the cash flow statement and close to about 80 odd crore on the balance sheet.
No. So no, that's a wrong reclassification that has happened. And if you look at it, the console basis as well, and the newer balance sheet that has been uploaded, this has been corrected, and the same number of receivables versus your balance sheet versus cash flow, you would be able to see. And even if you see consolidated, you will see that.
Okay.
Right? That is around 70 number. The number will be around 70 there.
I'll just take a look at that. And if there is anything, I'll come back to you. Thank you so much. All the best.
Pleasure. Thank you. Thank you, Ethan.
Thank you. The next question is from the line of Rishabh Sisodia from Concept Investwell. Please go ahead.
Yeah. Hello, sir. Am I audible?
Yes, sir. Please proceed.
Yeah. Thank you for the opportunity. So just a few questions. On the new products that you have mentioned in your slide about the fluorination chemistry, so we have mentioned a top line potential of close to $200 to $260 million. And if I remember in the previous calls, management said it would take around 2 to 3 years for us to build capacity. It would be decided whether it would be in Tanfac or in the Anupam's own facility for these new fluoro-based chemicals. So is that the right estimation, that we should have a 2 to 3 year time frame before this revenue starts flowing up? And what type of, how many molecules are we looking at getting commercialized post we have our capacities every year?
Anand bhai, would you want to take, or should I take this?
No, go ahead. Sure.
Okay. So just to first quickly say this, one, that currently also we are doing fluorination. It is not that as if we are not doing any fluorination products. Today also, if you look at my revenue, for around 15 to 16% of my revenue would come from molecules which have fluorination as one of the processes at least. The key thing that is happening is that by the acquisition of Tanfac, what has happened is that I have now got access to HF, which is a very, very good fluorinating agent, in addition to KF, which is where we have been using it till now. So now that's one part of it. You are right that the HF based products would take little time to ramp up. There may be 1 or 2 products which we will be able to manufacture in our current capacity and in our current fluorination processes. But yes, you are right. Largely, it will start building up from over 2 to 3 years forward.
And just a small follow-up on this. So this $220 to $260 million is over and above the current LOI contract that you have mentioned, right?
That assumption is correct.
Yeah. Okay. So my second question is, if you look at the revenue split on the India and the export business, so we see the India business has grown marginally over the last 1 year, and that has also impacted our margin. So is it that we in the exports, are we seeing any logistic issue, or is there higher demand for the domestic, or is it that there is a margin differential between the domestic and the international business that will be?
So one, I would not want to link margin and geography, because typically margin and geography has not much of a correlation in our case. Typically, we work on a product basis rather than geography basis. So this margin increase is just one event. And on the geography distribution side, in any given year, the number may move around a bit in terms of domestic, international, even in international versus Europe versus Japan versus Singapore. That may happen, but overall you can see that this trend of 40 to 44%, 45% India and the balance international, we expect it to be in the similar range.
Okay, so that's helpful. And the margin that we are doing in the current quarter should be sustainable going ahead, right?
Not the current quarter. I would tend to go with my current year or last couple of years average. That's where I would keep it at. So yes, we have, but I would not want to be aggressive on my commitment here, because I would want to say it here that way.
Okay, thanks a lot. And just one last question. Are we looking at increasing our stake in TANFAC, maybe through open market operations or from the government itself?
So the answer is that in the agreement that we have with government of Tamil Nadu with TIDCO, they have an option to offer us, and if they offer, we'll be happy to accept that offer.
Okay, that's it. Thank you.
Thank you. The next question is a follow-up from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Hello. Thank you very much. So going back to this 50 crore capex you are planning for TANFAC, can you give us some details in terms of what is the capacity, what are the products you are planning?
So the products are the existing products, which is KF and HF, where we will have a capacity enhancement, and largely this will be more from a debottlenecking process rather than a hard large capex that you would see, right?
Okay, and then the second thought is, can you give us what is the likely increase in capacity in Anupam once you complete your 50 crore capex? Right now it's 27,000. So what is the kind of additional tonnage you create based on 50 crore capex?
So I would not want you to look at it more from a tonnage perspective, but I would want you to look at it more from the revenue that we would be able to accumulate, and that's where we would be looking at around about 450 to 500 crores of revenue from this 450 to 475 crores of revenue from this assets.
And this will be in Pachhin itself or between Pachhin and Gadoliniya?
Mr. Ramesh? So sorry to interrupt. Your voice is not clear, sir, in between. If you can take the phone closer to your mouth, please.
Hello, can you hear me now?
Yeah, this is better, sir.
Yeah. So is 2 crore capex, where are these facilities likely to be located?
It would be both so there will be an expansion in our Sachin plant as well, and also in the Jagadia plant as well. So it will be in both the locations.
Okay, and this will be mostly for the producing part of the plant, mostly in terms of the gross block required for production. Any infrastructure also required in this?
Significantly, not much infrastructure requirement will be there. There will be some bit of construction that will happen, but largely yes, it will be more for the equipments and the reactors and others.
Thank you. That's helpful. Thanks a lot, and wish you all the best.
Thank you, Ramesh.
Thank you. A reminder to the participants: anyone who wishes to ask a question may press star and 1 at this time. As there are no further questions, I would now like to hand the conference over to Mr. Vishal Thakkar for closing comments. Over to you, sir.
Thank you. So with the successful completion of our first year after listing, I want to thank all our shareholders and partners who have given us full support and support in this journey. We hope that we have covered most of your questions. If you still have any further questions, please feel free to reach out to our IR agency, EY. Stay safe and have a great weekend. Thank you.
Thank you. Ladies and gentlemen, on